Investors entered 2017 with a degree of trepidation ahead of the inauguration of Trump as president in the US, of course. But in the event, markets had a very benign period with good solid performance from most asset classes. Equities performed better than bonds. Within bonds, credit outperformed sovereign debt. But generally speaking, a period of solid performance, low levels of volatility. I think the markets were perhaps most remarkable for that, 6-year lows in volatility. So an encouraging and positive start to the year, and actually continuing the pattern that we've seen since Trump's election back in November last year. The key fundamental factor underpinning markets in the first quarter has without doubt been a pickup in growth in the global economy. To date, we've seen the US economy performing pretty well, but in the past quarter, we've seen an acceleration in growth, particularly in Europe, that's been encouraging, and what that's being translated into improving corporate profits. We've had a 2-year period of pretty sluggish profits, particularly in the US. We're now seeing quite a pickup in corporate profit growth in the first quarter of this year, probably around 10% or thereabouts. So that was without question the major driving force. At the same time, the Fed actually tightened policy in March, a little bit earlier than it had sort of flagged, but investors were able to shrug that off because of the strength of the economy and the fact that the Fed has remained pretty much on track in terms of its expected interest rate rises through the remainder of this year. So still a fairly loose monetary policy and ultra loose monetary policy elsewhere around the world, combination making actually a good backdrop fundamentally for markets. Well, nothing is ever plain sailing in markets, of course, and we entered this period with high expectations about Trump's reflation agenda. Now, what actually happened that slightly disturbed confidence in that during the quarter was the failure of Trump to get through the Obamacare reforms in Congress. That by itself didn't matter very much, quite frankly. What does matter much more is whether he'll get these big tax reforms through, because they're the things that, of course, will drive growth. And that's what investors have been pushing markets up to in expectation of that higher growth rate. So it's beginning to look as if the sort of political reality of Congress, the checks and balances in the Constitution will actually slow down that process of implementing reform. And investors are beginning to say, well, it's actually going to come much later and maybe watered down. So that was sort of a negative effect, whilst the economy itself was doing pretty well. It was one of the reasons why I think that we've seen actually bond yields slipping back a little bit in recent weeks. Perhaps the biggest surprises in the quarter have been the fall in the US dollar and also the fall in bond yields in the US and even more so in the UK. And that happened despite the fact that the Fed continued with its policy normalization process, that rate rise that took effect, and whilst all the other major central banks, the European Central Bank, the Bank of Japan, the Bank of England, all remained in ultra-loose monetary policy. So you've got these huge interest rate differentials between the US and elsewhere, but the US dollar still fell. I think to some extent it's a reaction to the fact that for 2.5 years the dollar has gone up in almost a straight line. That by itself is a policy tightening. And at the same time, we've had this stronger growth in Europe, pickup in growth in Japan, and of course headline inflation picking up a little bit around the world, all suggesting that in due course the ECB in particular is going to start to become less dovish. It's going to start to rein in its ultra-loose policy. So I think they were the factors underlying this quite surprising move in markets in that first quarter. Although the US stock market has led the world for quite some time now, outperforming all other developed markets by a huge margin since the financial crisis, there were some signs during the course of the past few months that things were beginning to change, particularly in Europe, where we've had a very clear acceleration of growth, and indeed where the political risks have actually diminished during the quarter. There were a lot of concerns about the long-term future of the euro area, the eurozone, and indeed the EU, post, of course, the UK referendum result. But in the event, the elections which took place in the Netherlands did not result in any surge in support for the far-right anti-immigration parties. Marine Le Pen's chances of winning in the French presidential election in April and May this year have definitely diminished. That looks extremely unlikely. So for now and for some time in the future, I think the euro area is safe. So those were positive factors that helped the European stock markets to perform, and they were the best performing stock markets in the first quarter, as a matter of fact. Well, markets have been strong this year, and indeed they've had a very good rise since the election in November, and they've been very encouraged by this accelerating global growth. They're looking forward to Trump's reflationary policies, but as we've seen, there are some hurdles on the way. The extent to which those policies will be implemented, the pace at which they'll be implemented, the timing, all of that has been put into some doubt. So there are some quite significant political and policy risks there. And at the same time, this strength in markets has pushed valuations to pretty high levels globally. So I think a period of consolidation wouldn't be a surprise at all to see this very low period of volatility perhaps be interrupted by who knows what, some form of concern that will cause markets to set back. I think that's sort of becoming a little bit overdue. Having said that, we are in a very long cycle here, and what we're seeing is a sustainable global economic recovery. Inflation is not accelerating away to an extent where central banks have really got to tighten policy. So this cycle is going to go on for some time yet. And yes, there will be some bumps on the way. Markets need a correction after what we've seen. But our message is stay invested. There are going to be opportunities out there over the next couple of years. And indeed, if markets were to have a setback, we think that is an opportunity to add risk to portfolios.